Hello again, traders. Doing Shopper there from DRFX, Forex and Trading. Going to be taking a quick look at the recent trade that was made on the Euro Aussie dollar last week, which provided us with a strong trading gain of 88 pips as we took advantage of the decline on that currency pair over the last couple of days. Now here you see the graph of the situation of this currency pair on the daily chart several days ago, where the market gave a strong bearish candle indicating the start of a false breakout reversal that would take us back inside of this consolidation and back towards the support boundary. So the expectation was that over the next couple of days, the market would provide us with a trading opportunity to take advantage of this expected decline. Eventually, the market did provide us with this trading opportunity, which took the form of a consolidation breakout on the 4-hour chart. As you can see here, the market formed this pennant setup as part of the downtrend that had started on that time frame, and we took advantage of the breakout that was taking place below the support boundary by entering at the close of the second candle here and placing our stop loss just above the trend line of this downtrend. Trading target was set to an area just above the support boundary at 141.44, and we entered the market at 142.64, targeting a trading gain of 120 pips. At the end of the 2-day holding period that we had established for this trade, the market provided us with the market was up, the trade was up by 88 pips, and so we had to close the trade for this trading gain instead of the projected or the expected trading gain of 120 pips. Nevertheless, it was a strong trading gain as we took advantage of this very profitable movement over the last couple of days. Now, with regards to my trading methodology, I usually set holding periods for different types of trades, depending on how long I expect the market to take to hit the trading target. In this case, since we were aiming for 120 pips, usually the market takes at most 2 days to hit these types of trading gains. So that was the rationale behind setting the 2-day holding period. And in most cases, the market would hit the target within that period, but in some cases, it would come up short, and we would have to close the trade for a trading gain slightly lower than what we had been expecting. So this was an example of that situation in which we had to close earlier for a smaller trading gain than we had planned. But nevertheless, it was a very strong trading gain that took advantage of this movement here. Now, this recent trading gain has now pushed the return so far for the 2016-2017 period up to 12%, which relative to 2015-2016 is a much stronger start. Now, what this means is that relative to our projection for our 12-month projection, we're actually now 12 trades away from hitting our 100% rate of return target. So assuming that we have a fairly smooth ride with maybe a few hiccups along the way, we should be able to hit that target and of course hit strong rates of return targets along the way. So that 12%, this current 12% rate of return has placed us just between these first two trades. So over the next couple of weeks and months, assuming liquidity is fairly strong in the currency market, we should be able to take advantage of trading opportunities that the market provides for us to hit this trading target. Now, the main technical element or the main technical factor that underlie the Euro Aussie dollar trade had to do with that of false breakout reversals. These are very common across the currency market and across all time frames, where the market would attempt to start a breakout at one end of the boundary, only to be followed by a sharp reversal that takes out that initial attempt and leads to a movement back inside of the consolidation, and in most cases, a breakout at the other end of the boundary. So this was the setup, and this was the theory behind the trade on the Euro Aussie dollar. Now, the main reasons that these reversals take place is that We could have a situation in which the market was going to be breaking out against the main direction of the trend, or in some cases, and in most cases, the breakout signal that actually attempted to start the breakout was actually too weak. So weak candles and a breakout taking place against the main trend direction are two of the most common reasons why the market would create these false breakout reversals. So once we can spot the fact that we will be trading against the trend, or that the signals will be weak, we can avoid trading at these areas here and avoid the initial loss, and focus on the reversal that is going to take place, and focus on taking advantage of it and capturing a strong trading gain. So this was the principle behind the trade, and across the currency market and across all time frames, we can look out for these types of setups and avoid the initial loss, and focus on the trading opportunity that is going to be presented as the market reverses and heads back inside of the consolidation.